How to create a trading journal. A trading journal is a systematic record of trading decisions and outcomes. It goes beyond listing wins and losses. It captures the entire decision-making process, including the setup you used, why you entered, how you managed risk, what you felt during the trade, and how it ended. A good journal provides context for every trade. For example, two losing trades can have completely different meanings. One loss may be a clean, disciplined loss in a valid setup. The other may be an emotional gamble with no structure behind it. Without a journal, both look the same on a statement, a minus sign. But with a journal, only one is a mistake. A journal forces you to record the truth behind the trade, not just the result. It shows whether you followed your rules or acted impulsively. It also shows whether the strategy you are using truly fits market conditions. Over time, your journal becomes a personalized database of how you trade best. It shows which timeframes give you the highest accuracy, which setups fail too often, which conditions favor your strategy, and whether you remain consistent as volatility changes. It also reveals whether you have emotional patterns such as impatience, hesitation, fear, greed, or overconfidence. The journal is your blueprint for understanding your trading identity. Every trader has one, even if they don't realize it. Some trade well in high volatility. Some trade better during specific sessions. Some thrive with trend setups. Some excel in ranges. A journal brings these traits to the surface so you can build your strategy around what actually works for you. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 25% off your next purchase. A trading journal forces accountability. When every trade must be recorded, you naturally avoid low-quality setups because you know they must be documented. This reduces impulsive trading immediately. It also pushes you to refine your strategy because the journal reveals whether your rules actually work. If your setup fails 60% of the time under certain conditions, the data will show it. This prevents you from guessing or relying on hope. Emotions lose their power when confronted with clear data. A journal also helps you develop discipline. Consistency is the most important skill in trading, and it is impossible to measure consistency without documentation. If you follow your rules only when you feel confident, you will never develop a stable trading identity. A journal shows when rules were broken and how much money was lost because of it. This transforms mistakes into measurable costs, making it easier to avoid them in the future. The journal exposes emotional tendencies that traders rarely notice in real time. You may think you are calm and rational, but when reviewing your journal you may find you frequently size up after a win. You avoid setups after a loss. You chase moves near major news releases. You exit early when in profit but hold losers longer. These tendencies weaken performance more than bad entries. A journal highlights them with undeniable clarity. Finally, a journal separates randomness from structural issues. A losing streak may be caused by market volatility dropping, your strategy not fitting current market behavior, or simply normal variance. Without data, you cannot tell. With a journal, you can identify exactly why performance changed and adjust accordingly. A journal helps traders evolve faster than any other tool. It compresses learning time by extracting lessons from every trade, creating a continuous improvement cycle. It reveals which strategies you perform best with, which environments support your style, and which behaviors cost money. It becomes a map of your personal edge. This is something most traders never discover because they chase new strategies instead of refining the one that matches their natural tendencies. A journal helps traders identify patterns in both winning and losing trades. You may discover you trade best at market open but perform poorly at midday. You may find your highest accuracy occurs when volatility is rising or when price is near a specific moving average. You may notice certain chart patterns work far better for you than others. This information is priceless because it shows where your true strength lies. The journal also improves emotional control. When you document fear, hesitation, or impatience, these emotions become measurable and manageable. Over time, the emotional notes reveal triggers that cause poor decisions. Once you recognize emotional triggers, you can plan for them and reduce their impact. Journaling also increases confidence. When you see data proving your setups work over hundreds of trades, your confidence becomes grounded in fact, not hope. This reduces second-guessing and strengthens decision-making under pressure. Confidence built on evidence is one of the strongest advantages a trader can have. A trading journal should be structured, simple, and consistent. Most traders use spreadsheets, digital journaling platforms, or handwritten notebooks. The tool itself does not matter as much as consistency and accuracy. A functional journal includes trade details, reasoning, risk management, emotional notes, screenshots, and lessons. The goal is to capture both the objective and subjective aspects of the trade. Objective data shows performance patterns. Subjective notes show emotional tendencies. A well-structured journal entry includes the setup or reason for the trade, the market conditions at entry, the time frame used, why you believe the trade had an edge, your stop-loss placement and risk, your target, your emotional state, how the trade unfolded, what caused the exit, whether you followed your rules, what you learned. Screenshots add clarity because charts look different after they move. A screenshot preserves the exact structure you saw at entry. This helps you identify whether your trade idea made sense or was influenced by emotion. Most traders benefit from using a hybrid system. Digital logs handle numbers and analytics. Handwritten notes capture emotions and thought processes. This combination creates both statistical clarity and psychological insight. Record everything that influences your decision. Include the market structure, trend direction, volatility conditions, support and resistance, indicators, and price behavior. Document the strategy you used and why. If the trade was based on a rule, record the rule. If it was based on instinct, record that too. Over time, you'll see whether instincts help or hurt. Record your emotional state before, during, and after the trade. Many trades fail not because of strategy, but because emotion interfered. Documenting your emotions reveals the patterns that need correction. Were you anxious? Were you tired? Were you trading after a previous loss? These details matter more than many traders realize. Finally, record what you learned from each trade. The lesson is often more valuable than the profit or loss. Digital journals offer automation, analytics, charts, and performance breakdowns. They are ideal for high-volume traders who want statistical clarity. They show metrics like win rate by strategy, average reward to risk, time of day performance, and expectancy. Manual journals allow deeper reflection. Writing forces the brain to slow down and examine thoughts more thoroughly. It helps highlight emotional tendencies and mental patterns. Some traders use both, digital logs for data and handwritten notes for psychology. The right approach is the one you can maintain consistently. Reviewing your journal is where transformation happens. Patterns emerge only when viewed in batches, not trade by trade. You might find that a setup you believed in is actually unprofitable. You might discover your accuracy increases when volatility rises or when price is near a moving average. You may see that your risk-to-reward ratio is too small or that you trade too aggressively after winning streaks. Review sessions help refine strategies. You eliminate weak setups and strengthen your best ones. You adjust stop placement, entry timing, position sizing, and exit logic based on data. This produces a cleaner, more efficient strategy. Reviewing your journal also builds confidence. When you see proof your strategy works, it becomes easier to follow rules, and this reduces hesitation and emotional interference. Traders without review sessions remain stuck because they cannot measure progress or identify the source of mistakes. Conclusion: a trading journal is a powerful tool for building discipline, structure, clarity, and consistency, and it reveals how you actually trade, not how you think you trade. It captures decision-making, emotional patterns, strengths, and weaknesses. It allows you to refine your strategy based on evidence instead of opinion. Whether you trade stocks, crypto, forex, or futures, a journal accelerates growth and reduces emotional mistakes, and the journal turns every trade into a lesson that compounds over time. It is the difference between guessing and evolving. Thank you for watching.